Now let's look at Chapter 4, an introduction to debt instruments. In Chapter 3, we focused on equity securities. Equity means ownership. So people who own equity securities are owners of the corporation. In Chapter 4, we'll turn our attention to debt instruments. What are some of the key topics we'll be exploring in Chapter 4? Well, we'll start by looking at the characteristics of bonds. We'll look at bond basics, if you will. We'll then get into bond pricing. We'll see how to price the bond. We'll learn about a couple of very important things that affect the bond's price: interest rates and credit risk. Then we'll explore prices versus yields. We'll learn about the inverse relationship between bond prices and yields, and we'll introduce what yields are. Now, this is a concept that we'll get further into in Chapter 6 when we look at investment returns. We'll then look at the retirement of debt. Bonds have a maturity date where the issuer will repay the par or face amount, but we'll also learn that not all bonds make it to that final maturity. They might have a call feature or they might have a put feature. And finally, we'll look at convertible bonds. Some corporate bonds are convertible into the common stock of the corporation, a very important feature if it exists. Let's start with bond basics. Well, what is a bond? Well, here we have a borrower who needs money. Now, who might this borrower be? This borrower might be a corporation. It might be a municipality, like a city, a state, a county, a school district. They need money. They often borrow money. Or it might be the federal government that issues treasuries. They're borrowing money. So we'll look at those different types of issuers in a later chapter. This chapter will focus on things that are true with all bonds. So we have this borrower who might be a corporation, a municipality, or the federal government. They need money. Where are they going to get this money? From investors. The investors are lending money to the issuer of the bonds. The issuer is issuing these bonds. Now, what is a bond? Notice a bond represents a loan or debt obligation of that issuer. They are borrowing money. So the investor is lending money. They become, we'll see, a creditor, not an owner of the entity. The borrower is responsible to pay interest on these bonds. Generally, the interest is fixed over the life of the bond. We'll see that there are variations on this where you might have floating rate instruments or you might have zero coupon bonds, but generally the interest payments are fixed over the life of the bond. Also, the borrower is responsible to repay the principal at some future maturity date. So what is this investor getting from buying the bond? The investor is a creditor. They are receiving those interest payments, so they're getting these consistent interest payments, and we will see that bonds generally make interest payments semi-annually. So they're receiving these semi-annual interest payments, and they will also receive their par amount or principal or face value back at maturity. The bondholder is not an owner of the entity of the corporation or municipality or federal government. Instead, they are a creditor. It means they are owed money. Now remember, very important, creditors have priority over owners. Remember, the owners are the stockholders. So the creditors are senior securities to those stockholders. What that means is if the corporation is being liquidated, the creditors get paid before the stockholders, even before the preferred stockholders. Creditors come before owners. Well, if you've ever borrowed money, what do you know when you borrow money? You have to make the payments. So the borrower must pay those interest payments and that eventual repayment of principal or they will be in default of the loan, and the creditor would have legal recourse, being a creditor. Well, let's take a look at a question, and when these questions come about, feel free to pause the recording, use your workbook, and answer the questions. For investors, what is the attraction to owning bonds? Well, the attraction for owning bonds is that you are getting these consistent interest payments from the issuer, and at some future maturity date, you will receive back your principal or par value on the bond. And we'll look further at that in a minute. So typically, you're getting consistent income from the bond, and you have this known maturity where you will receive your principal or par value back. And remember, you're senior to the stockholders. So if there is a liquidation, you will be higher in the pecking order. You will get paid before any stockholders. Also, if they miss the interest payments, they are in default. You have legal recourse. This is not like dividends on stocks, which are declared at the discretion of the board of directors. This interest must be paid to the investors. Now let's look at some bond terminology. This is a very important slide to feel very comfortable with, because we're going to look at really the basics of bonds here. So here we see we have a general training 10% debenture due January 15th, 2000 and something. It has a 10% coupon or nominal interest rate, and the par value is $1,000. So let's take a look at these features a little bit more. Here we could see that the par value is $1,000. That is what's sometimes referred to as the face value or the principal. This is important for two reasons. One, the interest payments, which we'll address in a second, that 10% coupon, is 10% of $1,000. Or this bond we're going to see pays $100 a year in interest because it's a 10% coupon bond. The interest is always calculated by multiplying that coupon times the par value, regardless of what you actually bought the bond for. The issuer doesn't care that you might have bought the bond for $980 or $1,020. The issuer is paying 10%, in this case, of $1,000 or $100 a year. The second thing that's very important about this par value is this is what you will get back at some future maturity date. Again, regardless of what you paid for the bond, whether you paid $900 or $1,100, what is this issuer paying back at maturity? They are paying back $1,000. Now, when will they make this payment? They will make this payment at some future maturity date, or sometimes called a due date. Here we could see that it's January 15, 2000 and something. Now, it's important to note that the way we lay out the month and day in the United States is it's month, day, year. Most other countries don't do it that way. The U.S. does. So 1/15 is January 15th. On that maturity date, you will receive your last interest payment and the repayment of the par amount. So we'll receive our last semi-annual interest payment and the repayment of the $1,000. Again, regardless of what we actually bought the bond for. The issuer doesn't care. They're paying par value at maturity. Now, we mentioned that interest rate of 10%. This is generally fixed over the life of the bond. There are some bonds that have floating rate instruments where the interest rate will be reset periodically. And there are some zero coupon bonds, which we'll look at later in the program. which you buy at a deep discount and mature at face value, and the difference is your interest. But generally, and for the vast majority of questions on your exam, you'll get a coupon or interest rate that's a fixed percentage over the life of the bond. So this is set when the bond is issued. Here we're saying it's a 10% interest rate. Now it's important to note a couple of other terms for this interest rate. It is sometimes called the coupon rate, and it's sometimes called the nominal yield, the coupon or nominal yield. Now, the way this is stated is annually. So what do I mean by that? This bond pays 10% of $1,000 or $100 a year in interest. So this general training bond will pay $100 a year in interest per $1,000 par value. But it doesn't make $100 payment each year. Instead, the way bonds pay interest is semi-annually. So you will get $50 every 6 months. Okay, $50 every 6 months. So be careful on your exam. If it says how much will each interest payment be for, the better answer is $50, not $100. You have to assume that it's paying interest semi-annually, which is the way the vast majority of bonds pay interest in the United States. Now, let me address two other things. Here we see the due date, again, is January 15th. If you see a question on the exam that says, what will you get at maturity? Notice the best answer is you will get your last interest payment, so that last $50 semi-annual interest payment, and the repayment of the par amount, or $1,000 per bond. Now there's one more term here I want to address, since it didn't come up yet, and that's, we see the term debenture, a 10% debenture. A debenture, we'll see when we do corporate debt, a debenture is an unsecured corporate debt. It's an unsecured corporate debt. What unsecured means is they're not pledging any specific asset that's backing the bonds. Instead, it's backed by the corporation's full faith and credit. But no specific asset is pledged, like a particular building, okay, or a particular plane. Instead, it's backed by the good faith and earnings ability of the corporation. Okay, let's take a minute and look at a question. What are some other terms used for that interest rate? Well, if you remember, what we said is it's also called the coupon or the nominal yield. And again, this is generally fixed at the time the bond is issued, with some exceptions where you have variable or floating rates, which will be reset periodically. So if interest rates moved up, the interest payment would move up, or if interest rates move down, the interest payment might be adjusted down. We also have zero coupon bonds, which we'll look at, which actually pay zero interest. A lot of people say, why would anybody buy that? Well, you buy it at a discount to its face amount. It matures at its face amount, and the difference is considered your interest. And we'll look at that in a minute. Now let's look at two different types of issues: term issues and serial issues, or sometimes referred to as term maturities and serial maturities. Now, in both of these, the bonds are issued on the same date, and interest is paid each year. So what's the difference? With term bonds or term maturities or term issues, the entire offering matures on one date. So for example, a corporation might issue bonds today, and when do they mature? They all mature January 15th, 2032. That would be a term issue. The entire issue matures on this one date. With serial issues or serial maturities, again, the bonds are all issued today, but Some of the bonds might mature next year, some mature in 2 years, some mature in 3 years. So they're maturing each year until the entire issue is redeemed by some future date. So it's really like there were numerous different bonds issued, but it was all issued today as part of one big serial issue. Now, sometimes the way the serial bonds are structured is so that they have a relatively what we call level debt service. Debt service refers to the payment of interest and principal. So again, debt service refers to the payment of interest and principal. So what would a level debt service be? That would mean that each year the issuer is paying roughly the same amount in total interest and principal payments. So the principal and interest payments are approximately equal each year over the life of the bonds. And the way they structure that is, if you think about it, in the first year, since all the bonds are outstanding, we're paying interest on all the bonds that we've issued in this serial issue. And what we'll have is a small amount of the bonds mature. So we'll be paying off some principal. Now, if you think about it, the next year, the issuer will have less interest to pay. Why? Because some of the bonds have matured. So we'll have less interest to pay in total. So with the same outlay of money, what can we afford to do? We can afford to pay a little bit more principal. The following year, we'd have even less interest paid because now more bonds have matured. So with the same outlay of money, we can afford to pay a bit more principal. So the way they structure this is, as you go further out, there's a larger amount of principal maturing. But let's take a look at how this works with the term versus serial bonds. Here we might have $50 million worth of term bonds that are issued. Now, notice, they might be getting interest every 6 months. We're making the interest payments, but when does all the principal come due? All the principal comes due in this example in 2023. So notice, the whole $50 million matures on that date. What would it be if it were a serial issue? Well, this might be an example of a serial issue. We issue $50 million worth of bonds today, but how do they mature? $10 million worth of them might mature next year, $10 million the year after that, $10 million the year after that, until finally the last $10 million matures in 2023. Notice this is a serial issue. And it's really like there were 5 different bonds issued. As an investor, you know what you're buying. You might be looking for shorter term bonds. Somebody else is looking for longer term bonds. Each of these will have different coupon rates, but it was all part of this one big serial issue. Well, we've addressed a lot of different terminology. I would like you to take a minute, go to your workbook, and play a matching game and see if you can match the description to the appropriate term. So notice that we have a lot of different terms here. Bond, issuer, debt service, face value, coupon, and we have a lot of different definitions. Were you able to match them up? Let's take a look. So a bond. Well, what is a bond? A bond represents a loan or debt obligation of an issuer. The issuer is responsible for interest payments and the repayment of that principal at some future maturity date. And again, interest and principal is sometimes referred to as debt service. So debt service is the payment of interest and principal. The face value is the amount the issuer agrees to pay the investor when the bond matures. That will also be the amount that helps us calculate the annual interest. The coupon rate is the rate of interest, which generally stays constant throughout the life of the bond. If you take that coupon rate and multiply it by the par or face value, you would get the annual interest. Well, what's a term bond issue? It's when the entire bond offering matures on the same date. Where a serial bond, the offering matures over several years. So a portion matures each year. And what did we say that level debt service was? That's when the total of principal and interest payments is approximately equal over the life of the bonds. Now let's look at zero coupon bonds. We stated earlier that a zero coupon bond pays no annual interest, no semi-annual interest. So it has a zero coupon. Well, why would somebody buy a bond that pays no interest? Well, it's issued at a deep discount to face value. It matures at face value, and the difference is considered your interest income. So for example, the bond might be issued for $600. At maturity, the issuer pays off the $1,000 par value. The difference of $400 is considered your interest income on the bond. Now, one of the things about zero coupon bonds is even though you're not getting any interest until maturity, you actually have to consider it like you are getting interest income. This could be a drawback if it's a taxable zero coupon bond, because what you have to do if you bought it for $600 and at maturity you get $1,000, you have to assume that you're getting a portion of that $400 each year. It's considered your interest income, and if it's a taxable bond, that portion can be taxable. Then what you do is you increase your carrying value, or what's called your cost basis, by that amount. So for example, if the accreted amount, which is what this process is called, accretion, if you're assuming you got $40 in interest, then you would pay tax on that $40 in interest if it's a taxable bond, but you would increase your cost basis from $600 to $640. So if you sold the bond, you would calculate your capital gain or loss based on this accreted value, or what we sometimes refer to as your adjusted cost basis, that new carrying value. And what you do is you accrete your cost basis up to par value at maturity. Now, zero coupon bonds pay no semi-annual interest. So they trade without what we call accrued interest. Let's take a minute and address what accrued interest is. Accrued interest is what a buyer pays the seller when they purchase the bonds. They pay the price of the bond plus accrued interest. It's the interest that was earned since the last time the bond made an interest payment. Let me give you an example that will make it a lot clearer. Let's say that you buy a bond from me. I'm selling the bond to you in the secondary market. Well, the last time the bond paid interest was 2 months ago. So the next time the bond pays interest will be in roughly 4 months. I sell that bond to you today. Well, when the issuer makes that next interest payment, since you're the owner of the bond, the issuer will pay you the interest. You will receive the whole 6-month interest payment. The problem is you really don't deserve the whole 6-month interest payment because I held the bond for 2 months of that 6 months. You held it for 4 months. So how do we take care of this? How do we make that fair? Well, when you buy the bond from me, you'll pay me the price of the bond plus 2 months of accrued interest, what that bond has earned since the last interest payment. So you will pay me the price of the bond plus 2 months worth of what we call accrued interest. Now, in 4 months, when the issuer makes that next interest payment, they're going to pay the full 6-month interest payment. You get to keep that whole 6-month interest payment because you've already paid me the 2 months that I deserve. And that's what accrued interest is. Now, why are we addressing this with zero coupon bonds? Because there's a term we want you to know. These bonds trade flat. What does that mean? Without accrued interest. Without accrued interest. Since the issuer is not going to make these 6-month interest payments, the buyer does not have to worry about paying the seller accrued interest. What will happen to zero coupon bonds is as you get closer to maturity, the price will get closer to par value. Now, since you are getting no interest payments, you don't have to worry about reinvesting that interest. So they do not have what we sometimes refer to as reinvestment risk. What that means is you get more of a locked-in return over the life of that bond. See, in a normal coupon-paying bond, if you think about it, if you buy bonds with, let's say, a 7% yield, well, if that bond is paying you interest, it sort of assumes that you can take those interest payments and reinvest them at 7%. But if interest rates fluctuate, that may not be true. And that leads to what we sometimes refer to as reinvestment risk, the risk that you won't be able to reinvest the coupons at the yield to maturity, which we'll talk more about later. Well, zero coupon bonds eliminate that reinvestment risk. So who is this suitable for? It's suitable for an investor who's planning for a specific future need. So for example, you might be trying to fund a kid's college education, and they're going to go to college in 14 years. Well, if you buy 14-year zero coupon bonds, you will know in 14 years how much money you will have. Right? So you buy it at a discount today. If it matures in 14 years, you'll receive par value. You know exactly how much you'll have. You get a locked-in return over that period of time, and you don't have to worry about reinvesting coupons over that period of time. It might also be suitable if you're planning for retirement and you want to know how much you'll have at this future date. We said that a bond's price might differ from the par value. So par value is $1,000 per bond, but we said that you might pay more or less than this par value for the bond. Although most bonds are initially sold at par, as time goes by, these bonds will trade in the market for more or less than the par value. A bond that's selling for less than its par value is said to be trading at a discount. So if the bond was trading for $900, that would be at a discount to its par value. If the bond is trading for more than its par value, it's said to be trading at a premium to par value. So the bond might be trading for $1,100. Now, why would the bond fluctuate from par? There's two big reasons that you need to be comfortable with. One is that interest rates might have moved since those bonds were issued. So, for example, if interest rates go up, well, if that coupon is fixed over the life of the bond, if interest rates go up, new bonds are coming out with higher interest rates, that bond would look less attractive and the price would fall. We'll take a look at that in 1 minute. The second big reason why the bond price might have fluctuated is because of the credit risk of the bond. Remember, the bonds pay interest and eventually that repayment of principal. The issuer has to make those payments or they'll be in default. Well, how likely are they to default? Is this an issuer that has strong capability of making those interest and principal payments? Or is it a more risky issuer? We'll see if it's more risky, then investors will demand a higher return. So these are two huge factors that may make the bond fluctuate from that par value. So let's take a close look at this interest rate risk. A very important concept is that there's an inverse relationship between interest rate changes and the bond's price. So, as market rates change, notice that a bond's price will change in the opposite direction, or they have an inverse relationship. Why is this true? Let's say initially when the bond was issued, it was issued at par value, or $1,000, with a 7% coupon. Why? Because that's where interest rates were at the time for bonds with this risk and this maturity. So these bonds came out at par value with 7% coupons, giving investors a return of 7%, which is where market interest rates were. Well, what happened since? Interest rates went up to 9%. So now, new bonds with this risk and maturity are being issued most likely with 9% coupons priced at par to give the investor a return of 9%, because that's where interest rates in the economy have gone. Well, remember that 7% coupon is fixed over the life of the bond. So what's going to happen to the price of that 7% coupon? To make it attractive with today's rates at 9%, the bond would have to fall in price to a discount. See, the buyer wants to get a return of 9%. That's what they can get in comparable investments. So the bond would have to drop enough in price to bring the yield or return up to 9%. So that 7% coupon will trade at enough of a discount so that the new buyer would get roughly a 9% return. So that 7% looks less attractive, it would fall in value. But what if rates in the economy drop to 5%? Well, now that 7% coupon looks very attractive. Investors will pay a premium, or they'll pay more than par value to get that higher 7% coupon. So you would not be able to buy that 7% coupon for par value. Nobody would sell it at that price. That 7% now looks more attractive. It will rise to a premium. How much of a premium would it trade at? It would basically trade at enough of a premium so that the return for the new buyer is more like 5% when factoring in they're paying that premium. So let's take a look at an activity. A bond is quoted at 94.5. What that means is it's trading for 94.5% of its par value. Which of these statements would be true? Circle all that apply. Notice, choice 1, the purchase price of the bond is $9.45. Is that true? 2, the bond is trading at a discount. 3, the bond is trading at a premium. 4 is asking you what most likely happened to interest rates since the bond was issued. 4 is saying interest rates have more likely risen since the bond was issued. Is that true? So take a minute and determine which statements are true. You can circle any and all that apply. Okay, what's our answer? Well, the purchase price of this bond is $9.45. Is that true? Yes, it is. 94.5% of par value, so 94.5% of $1,000, it's $9.45 per bond. Choice 2, the bond is trading at a discount. Is that true? Yes, it is. It's at a discount to par value, which means it's trading for less than $1,000. 3 is not true. It's not at a premium. And 4, why did the bond more likely fall to a discount? Because interest rates have gone up. It makes that fixed coupon less attractive. So our true statements, notice, are 1, 2, and 4. So choices 1, 2, and 4 are true. The bond is trading at a discount of $945. Why did it most likely fall to a discount? That's probably an indication that interest rates have gone up. Now, the second big thing that can move bonds is credit risk. Remember that The issuer has to pay the interest and then make that eventual repayment of principal. Credit risk is the recognition that the issuer might default on that payment of interest or the eventual repayment of principal. Well, how likely is the issuer to default? How likely is the issuer to default? That might be hard for a regular investor to judge. And why is that important? Because issuers that are considered a high credit risk would have to pay a higher rate of interest to induce investors to purchase their bonds. Because you don't know how likely you are to get that interest payment or that eventual repayment of principal. So the more credit risk in the bond, the greater the interest rate should be. Okay, a very important rule of investing is the return should equal the risk-free rate plus a premium for taking on risk. Why take on risk? Because you should get a higher return. Well, securities issued by the U.S. government have very low credit risk. In fact, when we look at models and we assume a risk-free rate of return, a lot of times what we use is the return on a treasury instrument. So treasuries, U.S. government securities, are said to have very little credit risk. Credit risk might be more difficult to evaluate, though, if it's a corporation issuing the bonds or a municipality. Municipal bonds are not as safe as treasury bonds. Treasuries are backed by the full faith and credit of the U.S. government, which can print money, basically. Cities, states, and counties cannot do that. So municipal bonds, we care about that credit risk also. And a very important concept, bonds with higher ratings will have lower yields. Bonds with lower credit ratings have more risk. They would have higher yields. So bonds with higher ratings have lower yields and higher prices, all other things being equal. Well, how can investors try to judge the credit risk? Okay, how likely they are to get those interest payments and then the eventual repayment of principal? Well, a bond's credit rating is what many investors will look at. There's a few different rating agencies that are important for test purposes. Standard & Poor's, Fitch, and Moody's. And we'll address their ratings. So here we see the credit ratings for S&P and Fitch and for Moody's. Notice S&P and Fitch use all uppercase letters. So notice AAA is written AAA, and they're all in uppercase. Then we have AA, single A, triple B, double B. Where Moody's uses one uppercase letter, then lowercase. So notice the difference. And then when you go to the B's, it's BAA. Now, there's a very important distinction made in the financial community. The bonds from triple B or BAA, if you're talking Moody's, up, are considered to be of investment grade quality. The bonds below that are considered to be of speculative grade or speculative quality. The AAA and AA are generally considered to be high. A and triple B or BAA, if you're talking Moody's, medium. Then know a couple of other names for speculative grade. Know that they're sometimes referred to as junk bonds because they have more credit risk. But make sure you also know that they're sometimes called high yield bonds. High yield. Sometimes you want to stress the positive about the bond rather than the negative. How do you get someone to buy a more speculative bond? It will have a higher interest rate, a higher yield. So junk bonds are speculative, sometimes called high yield bonds. Now, we further differentiate between the ratings. Standard & Poor's and Fitch use a plus-minus system. So for example, an A+ would be better than an A, which would be better than an A minus. Then we would go down to a triple B plus, a triple B minus, and so on. Moody's uses a numbering system instead of the plus minus, with 1 being better than 2, which is better than 3. So an A1 would be better than an A2, then an A3. Then we would go to the BAA1, the BAA2, and the BAA3. Now, take a minute to answer the questions in your workbook. Who do you think pays for the rating? Who do you think pays for the rating? And as it relates to bond ratings, what's the concern? What are they trying to judge? Well, the first question, who pays for the rating? The issuer pays for the rating. And why does the issuer pay for the rating? Because if the bond was non-rated, investors would have a tough time figuring out credit risk, which might make it harder to market the bonds. And not every bond issue gets rated. Some small issues may not get rated, but larger issues generally do get rated. The issuer pays for the rating. Now, what is the rating agency rating? They're rating the likelihood of the issuer being able to make those interest and principal payments and how likely they are to default. So as it relates to bond ratings, what's the rating agency's concern? The risk of default. What they're judging is the risk of default. And again, remember the concept. The more risk, the higher the return. The more risk, the higher the return. Now, let's take a closer look at that bond price. The bond's price and the interest rate, as we saw, is generally stated as a percentage of the bond's par value. So if a bond is selling at 100, what that means is it's selling for 100% of its par value, or $1,000. And it would be said to be selling at par. But what if the bond was trading in the market at 90? What would that bond price represent? Well, that would represent a price equal to 90% of its par value. So $1,000 times 90%, and remember you do get to use calculators on your test. Okay, $1,000 times 90% would give us a price of $900 per bond, per $1,000 face value. If it was trading for 110, notice it's at a premium. 110% of $1,000 would give us a price of $1,100. So the bond would be trading at a premium. Now for corporate and municipal bonds, the way we further break down the price is it's expressed in points and in eighths of a point. So a point is a full percentage point. A point is a full percentage point. So notice 1% of $1,000 is $10. Or in other words, if a bond went from a price of 90, that would be 90% of its par, or $900, to a price of 91, that would be 91% of 1,000, which would be $910. So notice that 1 point move would be a $10 move. But we talk about it in smaller movements than full points. And for corporates and munis, it's often expressed in eighths of a point. And each eighth of a point is worth $1.25. So if you divided 10 by 8, you would see that each eighth of a point equals $1.25, or it's 1/8 of 1% of $1,000. For pricing purposes, convert the fractions to a decimal. Let's look at an example. 1/8 becomes 0.125. 5/8 would become 0.625. If you forget how to do that math, in your calculator, just put in 1 divided by 8, and you'll see the decimal equivalent of 0.125. 5 divided by 8 in your calculator will give you the decimal equivalent of 0.625. So if the bond is quoted at 93 5/8, converting that to a decimal gives us that the bond is trading at 93.625% of its par value. So then we could do 1,000 times 93.625%, and we'd get the dollar price per thousand, $936.25. So you can convert the fraction into a decimal, but then it's that percent of the par value. So 93.625% of the par value. If it's a $1,000 par value, that would give us a price of $936.25. So take a moment in your workbook and practice converting bond rates to dollar values for both price and coupon. So here we see a rate or a price, and we show you how to convert it to a decimal and then come up with the dollar value. So maybe a bond has a coupon of 5.25%. Well, 1 divided by 4 gives us the decimal equivalent of 0.25. So it's 5.25% of $1,000, or that bond would pay $52.50 a year in interest. How about a dollar price of 92.5? Well, that's 92.5% of $1,000, its par value, or a price of $925. How about a coupon of 6 5/8? Well, 5 divided by 8 gives us 0.625, so that's a coupon of 6.625% of $1,000, which gives us that the bond pays $66.25 a year in interest. And how about a price of 109 3/8? That's a premium above par. That's 109.375% of its par value, or $1,093.75. It's important to know how to convert the price or the coupon into dollar values. Now, the pricing of the government securities such as T-notes, T-bonds, and the government agency securities is done a little bit differently. First important concept is it's still a percentage of par value. It's still a percentage of the par value. That doesn't change. But what does is it's not in fractions of eighths. Instead, it's in 30/2 of a point. It's in 30/2 of a point. And by making it in 30/2 of a point, you can make the movement in price, or the difference between the bid and the ask, smaller. See, if we quoted it in eighths, then the smallest price move you could have is 1/8 of a point. But the Treasury market is a very large liquid market. So they want to make it more granular than that. The convention quoted it in 30/2 of a point. So it's important to note that these quotes for treasuries and the government agencies are in 30/2. So notice the quote of 87.24. And that could be 87.24, 87-24, or 87:24. Everything to the right of the dot, dash, or colon you need to know for a treasury is a number of 30/2. So that quote actually represents a price of 87.24 30/2 of a point. And that's still a percentage of its par value. So we do it the same way. We convert the fraction to a decimal. How? 24 divided by 32 in your calculator gives you the decimal equivalent of 0.75. So it's 87.75% of its par value. So if we multiplied that by 1,000, we would get it's $877.50 per thousand. Now, what if they gave us something other than 1,000? What if they gave us 10,000? Well, 106.04 is the quote. What's our first step? Convert it to the fraction. Okay, that's 106 4/32. Now, convert the 4/32 into a decimal. So it's 4 divided by 32 gives you 0.125. So that price is 106.125% of its par value, But if we were buying $10,000 worth, it's 106.125% of $10,000, and that would give us a price of $10,612.50 per $10,000. And notice it's trading at a premium. Now, T-bills are actually quoted differently. T-bills, instead of being quoted by their dollar price, are quoted by their yield, and it's what's called a discounted yield basis, not a dollar price. Now, in a T-bill dealer's quote, the bid will actually be a higher number. But remember, this is a yield. So the higher yield in their bid actually represents the lower price, while the ask would have a lower yield, and that would represent a higher price. So the dealer might be willing to buy it at a 3.5% discounted yield, or sell it at only a 3.45% discounted yield. So notice, the bid of $350 is a higher yield, it's a bigger discount, which is the lower price. The ask, which is the lower yield, would actually be the higher price. And when we look at different types of securities in the next chapter, we'll address treasuries in more detail. Now let's take a closer look at bond yields. So we've thrown around this term yields a little bit through this chapter. What is yield? Well, yield is the return that you get on the bond. So you might buy a bond for $900 that gives you a yield of 7%. What does that mean? Well, there's actually three different types of yields that you want to be comfortable with. There's the nominal yield, the current yield, and the yield to maturity. The nominal yield is the coupon rate, as we've said before. This is that fixed rate. This interest rate really tells you the amount of interest that the bond will pay. So if you bought a bond with a 7% coupon, that bond would pay $70 a year in annual interest per $1,000 face value. Remember, you just take that nominal yield, multiply it by par, and you could figure out the annual interest. And again, remember that bonds do generally pay interest semi-annually. So if you're getting $70 a year, it's most likely in $35 semi-annual interest payments. But notice that this yield really doesn't tell you your return on your investment. What if I bought that bond for something other than $1,000? I might be getting $70 a year, but maybe on $900 or maybe on $1,100. The second yield is the current yield. This relates that annual interest to the price of the bond. And it's a very easy calculation to do. All we have to do is take the annual interest and divide it by the price, and that will give you a current yield. But again, this yield really doesn't tell you your overall return on the investment either. Let's say that we bought an 8% coupon bond for a price of $900. Well, the current yield would just say you're getting $80 a year on an 8% coupon bond, and you spent $900 on it, so 80 divided by 900, it would say you're getting 8.89% a year on that $900. But if you held that bond to maturity, you would get $1,000 back at maturity, so you would make that discount. So the current yield really doesn't give us our overall rate of return. It just relates the annual interest to the price. And it's just simple division. The annual interest divided by the price gives you that current yield. The yield to maturity attempts to give you more of your overall rate of return on that investment if held to maturity. Now, this is sometimes called the basis. So you might have a bond with a 6% coupon trading at an 8% basis or yield to maturity. This yield to maturity attempts to give you more of the overall rate of return on the investment if held to maturity. This is a much more difficult calculation, and you will not have to do the calculation on your exam. It actually assumes a reinvestment of the coupons at the yield to maturity. The other big thing it takes into consideration is the discount made or the premium lost at maturity. So for example, if you buy a bond for $900, as we said, you'll get back $1,000 at maturity. So you're going to get paid at maturity $100 more than you paid. Well, the yield to maturity would take into consideration this discount made, or if you paid a premium, the premium lost at maturity. And it also factors in a time value of money. So it assumes a reinvestment of interest, it factors in a time value, and it factors in the discount made or the premium lost at maturity. And through that explanation, you could probably realize it's not an easy calculation to do by hand, nor is it an easy calculation to do even on a basic 4-function calculator, so the test will not ask you to calculate a yield to maturity. But it may ask you to understand the relationship between these three yields, which we'll look at in a second. But a couple of other terms. The term basis point. We said that one way of describing the yield, they sometimes refer to it as a basis. So a bond with a 6% coupon is trading at a 7% basis. What that means is a yield to maturity of 7%. That's your actual overall return. Well, we also need to know what a basis point is. A basis point is 0.01%. A basis point is 0.01%, a hundredth of a percent. Notice there are 100 basis points in one full percentage point. See, a yield move going from 6% to 7% would be a big yield move from 6% to 7%. So the way we talk about yield moves is a much smaller increment called a basis point. So a 1 basis point move might be from 6% to 6.01%. That would be a 1 basis point move. So from 6% to 6.25% is a 25 basis point move in yields. And notice there's 100 basis points in a full percentage point. Well, let's take a closer look at the relationship between these three yields, the nominal yield, current yield, and yield to maturity. If a bond is trading at par, all three of these yields would be equal. So if we had an 8% coupon bond trading at par, then the nominal yield or coupon is 8%. The current yield would be 80 over 1,000. 80 divided by 1,000 is 8%. And the yield to maturity, we're not going to make or lose anything extra at maturity. So we're getting $80 on 1,000 and we don't make or lose anything extra at maturity. Our yield to maturity would also be 8%. So notice at par, these three yields would be equivalent. But if the bond were trading at something other than par, they would not be equivalent. And the way you could always tell how the relationships line up is you could lay it out on the seesaw that we talked about earlier. The nominal yield is in the middle of the seesaw, or teeter-totter. That doesn't change. Then out to the right we have the current yield, and further out we have the yield to maturity. And you'll be able to see how these yields relate at different prices. So let's take a look. What if the bond traded down to a discount? Now, why would that happen? because rates go up, the price goes down. So we said that this was an 8% coupon bond. Well, what if market rates went up to 9%? Well, that 8% coupon does not look very attractive anymore. What will happen? The price will drop. How much will the price drop? Enough to bring the yield up to roughly 9%. And by yield, I mean that yield to maturity. Now notice if the bond is trading at a discount, if that line goes from the bottom left to the upper right, notice the yield to maturity will be the highest of the three, then the current yield, then the nominal yield. So the yield to maturity would be the highest of the three yields. Why, if the bond is trading at a discount, is the yield to maturity the highest? Well, remember, the nominal yield doesn't change. The current yield would be that annual interest over the price divided by the price. And our current yield would be higher. So let's say it's an 8% coupon, the price dropped to $900. Our current yield would be 80 divided by 900, which comes out to about 8.89%. Now, where would our yield to maturity be? It would even be higher than that. Why? Because it factors in, not only are you getting $80 on a $900 investment, but what are you going to get back at maturity? You're going to get back $1,000 at maturity. So you're going to make another $100 over the life of that bond because you're buying it for $900 and at maturity you're going to get $1,000. So the yield to maturity would be the highest of the three yields. Now, how much higher it would be would depend on the exact maturity. But what we want you to understand is just the concept that it would be the highest of these three. Now, what if rates went the other way? What if market rates fell? So we have this 8% coupon bond and rates dropped to 6%. Well, that 8% now looks very attractive. Notice the price would go up. So notice the way that line would slant from the upper left now to the bottom right, and notice the yield to maturity would be the lowest of the three yields. So if that bond were trading for $1,100, the current yield would be lower because you're taking that annual interest, dividing it by this higher price, this premium price. And the yield to maturity would be even lower because it's factoring in that not only are you getting the annual interest on the higher price that you paid, that premium price, but you're also going to lose that premium at maturity, right? Because you're only going to be paid back par value. So if you bought it for $1,100, you're only getting back $1,000. Now some people ask us, why would you pay a premium? Well, remember why you're paying a premium? Because the coupon or interest rate is higher than current market rates. So people are willing to pay a premium to get that higher coupon. How much of a premium are they willing to pay? Basically, enough of a premium so that the bond's yield to maturity is competitive with today's market rates, with today's interest rates. So the bond will rise enough in price to bring that yield to maturity down for that new buyer in line with today's market rates. Well, let's take a look at an activity in your workbook. Which statements are true? Again, you can circle all that apply. So statement 1, a bond's current yield is also referred to as its basis. 2, if interest rates are rising, bond prices are falling. 3, when bond yields are falling, bond prices are falling. And 4, if a bond is trading at par, its coupon, current yield, and yield to maturity are all the same. Which of these, any and all, are true? If we look at which ones are true, what do we get? Well, let's look at statement number 1. A bond's current yield is also referred to as its basis. That is not true. A bond's yield to maturity, which is really your overall rate of return, is often referred to as the bond's basis. And if a bond trader says a bond is trading to yield 4%, that generally means the yield to maturity. That's the most important of the yields because it's your overall rate of return. Statement number 2. If interest rates are rising, bond prices are falling. That is true. If interest rates are rising, bond prices are most likely falling. That inverse relationship. Statement number 3. When bond yields are falling, bond prices are falling. That is not true. Again, there's an inverse relationship between yields and prices. And statement 4, if a bond is trading at par, its coupon, current yield, and yield to maturity are the same. Is that true? Yes, it is. So our true statements are 2 and 4. If interest rates are rising, bond prices are falling. And if a bond is trading at par, all 3 yields would be equivalent. We talked about the maturity date. When a bond reaches its final maturity, the bondholder redeems his or her bond. The issuer will make the last interest payment and will repay the face amount or par value. From the issuer's point of view, when they pay off that bond and it is retired, it matures, it's no longer an obligation of theirs. So the issuer's obligation to the bondholder has ended and the debt is considered retired. Well, some bonds are redeemed before they mature. So how could a bond be retired prior to that final maturity date? Well, 2 big ways for you to be comfortable with are bonds might have a call provision, or sometimes said to be callable, or they might have a put provision, sometimes said to be puttable. Let's take them one at a time. A callable bond allows the issuer to call in the bonds or redeem the bonds prior to maturity. So notice, this is at the option of the issuer, not the investor. The issuer has the right to call in the bonds prior to maturity. Now, this could be an in-whole call where they call in the entire issue, or maybe they don't want to call in all the bonds, they're going to call in a portion of the bonds, sometimes called a partial call. Well, then how do they determine which bonds they call in? They will generally do it by lottery or random lot to decide which ones they call in if they're not calling in that entire maturity. Now, if called, what does the investor receive? They receive the call price, and we'll see that that call price is usually at least par value, if not a little bit more, a little bit of a call premium, which we'll look at in a second, plus any accrued interest that they're owed. Now, why would an issuer call their bonds in early? Make sure you know, because interest rates have more likely fallen. If you're an issuer, let's say you issued bonds with 9% coupons, and those bonds are callable. Well, let's say interest rates fall from 9% to 7%. Well, if you can call in those 9% coupon bonds, why as an issuer would you want to continue paying 9% for the life of those bonds? You could issue new bonds with lower coupons if rates fall. So let's say you could issue new bonds with 7% coupons. Take that money and use it to call in those 9% coupon bonds. It's what's sometimes referred to as a refinancing. It's sort of like what homeowners do when mortgage rates fall. They take out a new mortgage at lower rates and pay off their old mortgage. That's what the issuer is doing. Now, why would an investor buy a bond that's callable? Because if rates fall, which should normally be good for you, it will make your price go up generally. But here's a bond that the issuer has the right to call back in early. Why would the investor buy it? Well, callable bonds should have a higher yield than a comparable bond that's not callable. So in other words, the investor has to be compensated for giving the issuer that option to call in the bonds. How are they compensated? In the way of a higher yield. Two other features that protect investors to some extent. There is usually a call protection period. A call protection period. A period of time in which the bonds may not be called. A period of time in which the bonds may not be called. So for example, an issuer might issue 20-year bonds today, but they're callable beginning in 6 years. So if you bought that when it was issued, at least you knew it could not be called in during that call protection period, which in my example was the first 6 years. But it can be called in after that call protection has expired. A second feature is that if the issuer exercises their right to call in the bonds, quite often they'll pay a little bit of a call premium, which is an amount above par that the issuer will pay to call in their bonds. So maybe the call price is $102. So instead of paying you $1,000, they'll pay you $1,020. Now sometimes that call premium will go down the longer they wait to call in the bonds. So maybe if they call it in the first year, they'll pay you $102. But if they call it in the next year, they'll only pay you $101 3/4. The next year, $101 1/2. Very rarely would you see a bond callable at less than its par value. So it's callable at par value, if not a bit of a call premium. Now, the other way that the bond can be retired early is it might have a put provision. This gives the bond holder the right to redeem the bond or to put it back to the issuer prior to maturity. So you could sort of think of it like the opposite of a call provision. The call provision gives the issuer the right to call it back. The put provision gives the investor the right to put it back to the issuer. Why would this be attractive to the investor? When would they want to do this? If interest rates have gone up. Why? Let's say you bought a 7% coupon bond, then interest rates went up to 9%. Normally, your 7% coupon bond would fall because now market rates are at 9%. So that 7% does not look attractive. But here's a bond that might allow you to put it back to the issuer at par value. You can then take that par value and reinvest it at today's higher rates. So when would you take advantage of this put feature? When rates rise. We would be able to put the bond back to the issuer, get our par value back, and reinvest at higher rates. So why do investors purchase this? It allows the bondholders to redeem their bonds if rates rise at really more than the market value should be based on that interest rate rise. So interest rates rising will normally send your bond price down, but here's a bond you could still put back at par. You might want to add, why does the issuer give you that put feature? Because investors will accept a lower yield. So put bonds would normally have a lower yield than comparable bonds that are not puttable. So in other words, the investor is giving up something for that put feature. They're sacrificing some yield. Where callable bonds will generally have a higher yield because it's attractive to the issuer. Well, let's take a minute to answer this question in your workbook. Which of these statements are true? Again, circle all that apply. 1, issuers will likely call bonds when interest rates are low or have fallen. 2, issuers will make tender offers for their bonds when interest rates are low. Let me explain that. A tender offer is an open offer to buy in the secondary market. So a tender offer, unlike calling the bonds, is when the issuer offers to buy back the bonds in the secondary market. 3. Bondholders will exercise their put provision when interest rates are high, when they've gone up. Is that when bondholders would exercise their put provision? And 4, an issuer may call its bonds during the call protection period. So again, feel free to pause and determine which ones are true. So let's take a look at which ones are true. 1. The issuer will likely call bonds in when interest rates are low or have fallen. That is true. So if the issuer had high coupon bonds out there and rates fall, that's when they would want to call it in. They don't want to continue to pay that high interest rate. They might issue new bonds with lower coupons, use those proceeds to call in the high coupon bonds. The second statement, issuers will make tender offers for their bonds when interest rates are low. That is probably not true. They're not going to offer to buy them back at a premium, probably. If they were callable, they would be more likely to call them in when interest rates are low. 3. Bondholders will exercise put provisions when interest rates are high. That is true. That's when the bondholder will put it back, take their money and reinvest at today's higher rates. And 4, an issuer may call its bonds during the call protection period? No. The call protection period is a period of time in which the bonds may not be called. So notice our right answers are 1 and 3. Issuers will likely call in bonds when interest rates are low, and bondholders will exercise put provisions when interest rates are high. Now let's turn our attention to convertible bonds. This would be a very important feature for a bond to have, and this would only be in corporate bonds, where the bonds might be convertible into the common stock of the corporation. So what a convertible bond means is that the bond can be converted. It gives the investor the ability to convert that bond, taking that par value of the bond into a predetermined number of shares of the company's common stock. And again, the term debenture in this title just means an unsecured corporate debt. The convertible bonds provide the investors with the semi-annual interest that they're getting from being a bondholder, the safety of principal of a bond. What do I mean by that? Again, at maturity, the issuer will repay the par value. You don't have to sell it in the market for what it's worth. At maturity, you'll get back par value. And remember, as a bondholder, you're a creditor. So if the company gets liquidated, you'll be higher in seniority than the stockholders because you are a bondholder. So you do own a bond. You're getting the interest, the safety of the principal. But by it being convertible, you get another thing. What do you get? You get the possible appreciation in the price because the stock goes up. If the common stock goes up, that will affect your bond's price. Why? Because this bond can be converted into stock that's now worth more. So it will push up the value of your bond. Now, why does the issuer give you this conversion feature? Well, again, whenever you get something, you sacrifice something. So this may allow the issuer to issue bonds with lower coupons because they're giving you something else that's attractive, the ability to convert into the stock. But you don't have to convert into the stock. So if the stock goes up, at maturity the stock is worth more than the par value, you'll convert to stock. But if the stock is worth less than par value, you don't have to convert to the stock. You could still take your par value at maturity. So the value as a bond becomes sort of a floor for the price of the bond. Because you are a bondholder, it does have that inherent value as a bond. Now, when the bond is issued, the conversion price is generally at a premium to the price of the stock. And that bond's value will be influenced by what's happening to that company's stock. The price at which the bond can be converted into shares is sometimes referred to as the conversion price, and that's set at the time the bond is issued. Now, let's take a look at the formula, and then let's do a little bit of math with convertible bonds. So here we see the conversion ratio equals the par value of the bonds divided by the conversion price. So let's make a little bit more sense of this. The conversion ratio, what does that mean? It's the number of shares the investor will receive at conversion. And the way we figure out the conversion ratio, the number of shares you can convert into, is by taking par value and dividing it by the conversion price. So you can think of the conversion price, the price at which the bond can be converted. Again, it's set at issuance. And no matter what the bond is trading at, you take the par value. It's sort of like you're saying, instead of giving me $1,000, I'm going to take that $1,000 and use it to buy shares at this conversion price. So notice, if the conversion price was 50, 1,000 divided by 50 would show us that we can convert into 20 shares, no matter what happens to the price of that stock. And no matter where the bond is trading, to figure out the number of shares, all you do is you take par value, $1,000, divide it by the conversion price. So if the conversion price is 50, 1,000 divided by 50 shows us that we can convert into 20 shares. Whether that stock is trading at 16 or 28, whether the bond is trading for 900 or 1,100, doesn't matter. Take par value of $1,000, divide it by the conversion price, and you get the number of shares that you can convert into. Let's take this a step further and start doing some math. So example, XYZ Corporation has a 6% debenture that is currently trading at a market price of $1,100 and is convertible at a price of $20. What is the conversion ratio? Well, notice, we're giving you information that you really don't need to figure out the conversion ratio. The market price of $1,100 is just so you'll go wrong. How do we figure out the conversion ratio? We simply take the par value of 1,000 divided by the conversion price of 20, and we can convert into 50 shares of stock. So it doesn't matter what the bond is trading at, it doesn't matter what the stock is trading at, this bond is convertible into 50 shares. Now notice, if those 50 shares went up to $30 a share, we could still convert into 50 shares, but if that stock is worth $30 per share, then what we can convert into is worth $1,500. So notice how that makes our bond more valuable, because we can convert into something that's actually worth that much. So the bond would have to get pushed up in price. Now, the term parity. Parity means equal or equivalent. So they might give you the price of the bond or the price of the stock and say, what would the other one have to be trading at parity? Parity means the price of the convertible bond is equivalent to the value of the shares that you can convert into. So if the bond is trading at parity, what does that mean? The price of the bond is equivalent to the value of the shares that you can convert into. So let's take a look at this activity. Again, you can pause it if you want to try this alone, but it does cover some things we haven't really addressed yet. So some people prefer to look at this together. But if, again, feel free to pause if you want to try it on your own. So let's look at this question. A bond is purchased at $1,100. It's convertible at a price of $40. The market price of the common stock is now gone to $45 per share. Let's look at some questions and concepts around this problem. First, let's find the conversion ratio. Sort of quite often step one in any of the calculation questions on convertibles. So remember, to find the conversion ratio, we take par value of 1,000 divided by the conversion price of 40. It's convertible into 25 shares. So notice it doesn't matter where the stock is currently trading or the bond is currently trading. This bond is convertible into 25 shares, par divided by the conversion price. Well, what's the value of those shares that we can convert into? We can convert into 25 shares that they tell us in the question are worth how much a share now? $45, which means that the value of the stock that we can convert into is $1,125. So notice, if they said what would the bond have to be trading at to be trading at parity with the stock, the answer would be $1,125. That's the value of the stock. So for the bond to be at parity with the stock, it should be also trading for $1,125. Well, if converted, what is the stock's cost basis for this investor? It's what they bought the bond for, okay, which is $1,100, divided by 25 shares means our cost basis is $44 a share. So when you convert a bond, that is not a taxable event in that you have to pay tax on any sort of appreciation. Instead, what you do is you take your cost basis for buying the bond, which here they tell us in the question, the bond was originally purchased at $1,100. And if we convert that into stock, well, what do we have to show for that $1,100? We have 25 shares of stock. So simple division, we paid $1,100, and now we have 25 shares of stock to show for it. So our cost basis per share is $44 a share, or a total of $1,100 cost basis. Well, when does an arbitrage opportunity exist? What is an arbitrage opportunity? It means the ability to have a locked-in profit. Arbitrage is sort of locking in a profit. It's taking advantage of a discrepancy in prices where one shouldn't exist. When does an arbitrage opportunity exist? If a bond can be purchased at a discount to its parity price, why would that present an arbitrage opportunity where you could lock in that discrepancy? Because remember, the bond is convertible into the stock. So, if the bond is trading at a discount to parity, think of what you could do. You could buy the bond for less than the value of the stock. You can convert the bond into the higher price stock and sell the stock. And you can make that difference. So the bond really should not be trading at a discount. That's why it sort of has to get pushed up as the stock goes up. If it didn't, there would actually be an arbitrage opportunity where people would take advantage of that and aggressively buy the bonds, pushing up the price. Because you could buy the cheap bond, convert it into the expensive stock, and sell the stock. Or the way you could lock in the profit is you could buy the cheap bond and short the common stock it's convertible into. Then you can convert your bond to cover the short. And short positions we'll look at later on in the program. So that's jumping the gun a little bit if you haven't read that section and you're not familiar with the concept of shorting. But you can think of it, you can buy the cheap bond, convert it into stock, and sell that expensive stock. And in this case, what would present an arbitrage opportunity? If the bond was trading for less than the $1,125 that the stock is now trading for. So if that stock went up to 45, then we know that parity Okay, 25 shares of $45 stock is worth $11.25. If the bond was trading for less than $11.25, let's say it was trading for $11.00, you could buy the bond for $11.00, convert it into stock that's worth $11.25 and sell that stock and lock in the $25 profit. So that is convertible bonds. And that concludes Chapter 4 on an introduction to debt instruments. What's next? In the next chapter, we'll look at the specific types of bonds. We've talked about there's corporate issuers, there's the federal government, which is the U.S. Treasury securities, including T-bills, T-notes, and T-bonds, and the government agency securities, which are issued by government agencies. And there's also municipal issues, issued by states and cities and counties and school districts and so on. So we'll look at the specific types of bonds, looking at these different types of issuers, and the methods of underwriting these securities.